Hello, dear friends. I thought it's a good idea to talk about the particular topic today when it comes to our manual trading, namely going with the flow. And people underestimate the importance of that. Okay, markets are not only dynamic, markets have certain phases. They can be in a trending phase where the price goes into one direction day after day. They can be in a ranging phase where the price is like bound between certain price areas. They can be very whipsawy where the price action is very irregular and, let's say, dirty. So you need to understand that markets are fractal. They are multifractal. What does it mean? It means that even across time frames, if you look at the 4-hour chart and you compare this to a 5-minute chart, the nature of the price action is pretty similar, okay, generally speaking. So the more you zoom in, the more you zoom out, the price charts don't look that different. On top of that, we have certain phenomena such as volatility clustering, such as long-term memory in the price, such as scaling. Okay, these phenomena are captured also by certain tools of analysis. Now, we understand why that is because we see the market structure. We see how, there are position bar nests, okay, and the price goes away from them to price them in at least. We see how there are stop accumulations which are, cleaned eventually. Often they first go for the counter side, then for the main target. Then just before the main target, they may do a move in the other direction, a counter move. We have documented all these things. We see how sometimes the dumb money positions long, let's say, in the news go in the other direction. They do an exaggerated moves against the dumb money. We have seen gaps against the dumb money. All the at the end of the day, the price is the output of the whole equation. It's a two-dimensional output, okay, from all the inputs we have: dumb money positions, the stops, the orders, the dumb money tolerance, etc. Okay, phases are different. Every week is different, as you know. Some are easy, some are more tricky. Okay, some are very clean in terms of price action, some are dirty in terms of price action. As a manual trader, you need to be adaptive. You can't do the same thing day in, day out. That doesn't work. That's very important to understand. In most jobs or most other disciplines, you can repeat things over and over again. For manual trading, while of course there are trades which you do all over again, the market phases are different. They change. That is why also most automated systems die, after a few months, if you don't, have them designed in a complex manner, because the market phase just changes. The ranges just change. The nature of the price movement, the price action itself changes. The speed of the market changes. You understand? With slow markets, with fast markets, you need to go with the flow. You need to adapt towards those market phases. Okay, that's essential. That also implies that the trade frequency is different. Some weeks give you a lot of trades, other weeks do not give you a lot of trades. You cannot force trades on the market. That's the quickest way to lose money. All right? You can't balance slow markets with bigger position sizes or something like that. You understand? That's whenever you hear somebody saying, "Oh, I make this amount per day, this amount per week," it's BS. These are beginners. These people have no clue what they talk about. Weeks are different. Okay, some do not allow you to make a lot of trades. Others do. So you need to go with that kind of nature of the market, the flow, the rhythm. Okay, when it comes to your trade selection, your trade frequency, your leverage, you need to adjust. You need to be adaptive. That's why trading seems to be so difficult for many people, because they're not adaptive. They cannot change with the market. They cannot, control their urges, their emotions, their ideas of how it should be. They can't accept how the game is. Don't be like that, okay? The best traders, they are all adaptive. They are humble because they know that, things can change, and something which may have worked maybe not work the next week. So please be aware of this. If you use a market causality, you have such an edge already. You have leading information. You know when you don't, where you shouldn't trade, when you should trade. It's really amazing. This really gives everything you need in terms of your analysis. All you need to do is to control your emotions, to have proper risk management, and to go with the flow. Come on, it's not rocket science. Stay safe.